Good morning, good afternoon, and good evening from whichever location you are watching me from. My name is Prince Dunzo Onwade of Dunzo Lore Accountancy Tutorial. Today I'm going through a topic called Group Consolidation, which is governed by IAS 27 and is under financial reporting. It's one of the roles of financial managers to prepare a group account for the organization. Group consolidation is necessary, and this entails combining financial data of all members of the group to present a single entity, economic entity of the organization. As the parent company is responsible for all members of the group, transparency and responsibility is fostered by consolidation, as this will help various stakeholders such as customers, creditors, investors to make informed decisions about the organization. It is also strongly recommended or encouraged by regulatory bodies. We need to go through this using an example. This is a scenario here which I would like you to study carefully. It is the financial statement of Sandra and the subsidiary Smith Limited as at 31st December 2023. Look at the various information there. Making notes of the data you'll be needing for consolidation. Okay. If you read carefully, you see Sandra Limited acquired 80% of Smiths Limited on 31st December 2022. That's a year ago, when the balance on Smith's retained earnings was 1,150 and the value of non-controlling interest, which is minority interest, was 1,200. Sandra paid 2,500 for its investment in the share capital of Smiths. At the reporting date, Sandra recorded a payable to Smiths of £500. This agreed to the corresponding amount in both financial statements. This is intercompany transaction, which has to be eliminated during consolidation. Be careful. You are required to prepare a consolidated statement of financial position for Sandra Group for the year ended 31st December 2023. I hope you made note of the data you need for consolidation. Underline them. The acquisition cost, 2,500. The retained earnings as at that date, 1,150. Minority interest, which is non-controlling interest, 1,200. And the intercompany transaction in the balances, which is 500 in both the payable and receivable accounts of the group. Okay. Now let's move to the next slide. This is a financial statement of financial position in a vertical format here. On the right hand side are the data I was hinting you to be aware of. Data at acquisition date of Smiths Limited. First of all, make sure you have the structure which you need to prepare the group account. Sandra acquired 80%, leaving 20% to minority shareholders, which we call NCI. Ordinary share capital, okay, as at that date, 2,200. Retained earning, 1,150. Non-controlling interest, 1,200. H investment in S, very important. You identify this in the financial statement, the asset section, 2,500. Okay, and it's 12 months ago. Now, to get a quick mark in any exam, group consolidation, you need to look out for this section. Okay, non-current asset, current assets, non-current liability, current liability are all added together and put straight to the consolidation column. But the exception is when there is intercompany balances. So, as I said, PPE for both companies are added together to give us 9,700. The land of H 4,005, S 3,000 added together to give us 7,500. Investment, none other than the investment in the subsidiary, will be added as well and put straight to the consolidation column. Here, only 2,500 was that not relating to investment in subsidiary. That's why we added that here. Be careful. Don't add investment in subsidiary to the consolidation column. You need that for the goodwill calculation. Now, the next section, which is current asset, they are all added together and put straight to the consolidation column, with the exception of the intercompany transaction. So you can see the adjustment column here. I deducted 500 from both items to give me 2,200 here. And then the bank are added together, give us 6,000. Non-current liabilities are also added together to give us 12,000. Current liabilities are added together, and we need to deduct 500 intercompany balance. So that is 7,000 plus 1,800, deduct 500, give us 8,300. Okay. If you can do this quickly, you will score easy marks. As you can see, there are a lot of transactions here which can earn you mark if you understand this area properly. So let's move on to where we need to be more careful. The next slide here is where we now have to compute the goodwill. Investment in S, okay? The working will be adding all we paid and deducting all we got from S. S paid 2,500. NCI at that time is 1,200, meaning that we both paid 3,700 for S. Now, what do we get from S? So, what's net asset of S as at acquisition date? Ordinary share capital is 2,200. Retained earning as at that date, 1,150. Added together, got 3,350. If you deduct that from what we offered S in terms of cost of investment and NCI, you got a balance of 350. This is the goodwill. We paid more than what we got in financial terms from S. Smith Limited. That is the goodwill which is hidden, which is due to operation of S. We have to pay more for that. If on the other hand, we have to pay less due to maybe inefficiency in subsidiary or as a discount, the difference will be credited to the reserve. So that negative goodwill will be credited to reserve. Okay? Watch out for when we have to pay less than what we got from S Limited. Okay? The next working here will be the acquisition, will be the retained earning for the group. When we're doing this, we have to take head office holding company's earnings straight away to the consolidation. It is the S retained earning that has to be split into post-acquisition and then take the portion of H into account. So H, Sandra's Limited is 2,300. Smith post-acquisition is 1,650. And then H portion of that is 1,650 times 80%, 1,320. Okay. So if we add 2,300 to 1,320, that's how we arrive at 3,620 retained earning for the group. Go through this again and understand what we've done here. First, H figure is isolated and put straight to the consolidation. Then we need to get S whose acquisition retained earning. So you got to remove the earning, retained earning as at date minus that at acquisition to give you the balance post-acquisition. It is this post-acquisition balance you have to apply the percentage of H to get the 1,320, which we now add to 2,300 to give us the 3,620 for the retained earning. Okay, practice makes perfect. Go through this once more to make sure you understand what we're doing here. Now, the next working you need to carry out here is a non-controlling interest. How do we do that? We know that as acquisition date, they have 1,200. So that's the pre-acquisition. Their NIC was 1,200 from the notes. Now, what's the post-acquisition element for NCI? It is the current reporting date retained earning less the pre-acquisition retained earning, and then apply the 20% of it to arrive at the 330 for S. That is the subsidiary minority interest. Now, as a recap, you will notice that this is the consolidated financial statement on the right-hand side here. And this was the original information given to us for consolidation. If you follow this step from the beginning, you will score easy marks by going through them one by one, going to the non-current asset, current asset, non-current liability, current liability, and doing the intercompany adjustment. Then you go through the workings for the goodwill, the workings for the post-acquisition reserve, retained earning, and the working for the NCI. So the total for the equity is here 10,150, which is represented by total assets less total liabilities. These are the liabilities here. 20,300 is total asset. 30,450. Deduct that from, knock the total liability away from that, you get the equity 10,150, which is H ordinary share capital, then H reserve plus its share of S reserve, 3,620, and then the NCI 1,530. Okay. If you have enjoyed this particular tutorial, please give us a thumbs up and please subscribe, because by doing so, you are encouraging us to prepare similar tutorial for your consumption. Bye for now.